In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analyst's predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. I am now going to share with you my successful investing strategy for today's company, which is Paylocity. So stay tuned to find out how to evaluate a business. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. The first pillar we are going to explore is earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. For Paylocity, this is looking excellent for the trailing 12 months, as the earnings per share is 49%. Ideally, we would like to see the growth for each of these metrics increase by at least 10%. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health, and prefers companies that can generate substantial free cash flow. And here we can see Paylocity fared really well here, as their free cash flow is up by an amazing 39%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Paylocity's revenue has increased by 19% for the trailing 12 months. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value has also improved by a superb 23%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are excellent at 19 and 20%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow. Ideally within 3 years, and it would take them under 3 months to pay off their debt. At present, with the information we have gathered, it tells us that Paylocity's key pillars look fantastic so far, so let's find out more. Show me if you have enjoyed the video so far, by tapping the like icon and clicking on the notification bell. In this next section, we now focus on other key pillars which help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently a wonderful 69%, as we would like to see the gross margin over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is a fantastic 19% and is well above the ideal 14% we would like. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 3.45% this looks very good. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is 25%, with the lowest point being 10 years ago at 22%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 30%. Later on, when we create a valuation, I will use the lowest of these two average growth numbers to help project our future stock price. In the comments section, I've included a link to the investors page and the annual report, if you want to check it out for yourself. This is Bitesize Investments, giving you a step-by-step approach on your investment journey. Now let's look at past historical performance, to give us a better understanding of the company's successes or failures the business has been through. Looking at the chart, we can see that since 2020 the company has trading more or less sideways, but with some excellent highs during 2021 and 2022. However, since the high of $265, the company's share price has trended downwards, with some ups along the way. Earlier this year, Paylocity's share price hit a low of about $130, which is the company's lowest price since COVID. We can also see the current market cap is about $8.54 billion. Paylocity is currently generating $1.4 billion in revenue, and their earnings are $206.77 million. At present, their earnings per share tells us that for each share of stock, the company earned $3.63 in profit. And finally, the current P ratio is 42.36, which suggests the company is more expensive than the S&P 500, which has a PE of about 27. But their forward PE is 23.96. Now let's have a look at what the analyst's predictions are, which we should only use as a rough guide when reviewing a stock. On average, the analysts believe that the price target should be about $177, but some believe it can go as high as $250. And the overall consensus is they are a buy. Collectively, the analysts believe the company will continue to grow between 13% and 89% over the next few years. Now I am going to show you how to create a valuation. I will use the current earnings per share of 3.71. Now I use a combination of the past growth, future analyst predictions, and the average book value for the past 10 years, to create the estimated earnings per share growth. To create a valuation, I'm going to give Paylocity a 25% growth rate. Then, I am going to give them an estimated PE ratio of 30. After that, I will project these numbers forward by 10 years. We then need to include a 15% return from our investment. This then gives me an estimated future stock price of about $1,037 per share, for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $256. Then we apply a margin of safety. At 25% it gives me a buy price of about $192. Please share this video with someone you think will find it helpful. So, let me just recap. To get a good future return on the company, it would have to grow by 25%, and have a PE ratio of 30, over the next 10 years. Realistically, is this going to happen? Possibly, as Paylocity is still showing excellent growth, but is it sustainable for 10 years? Only if they continue to innovate, and develop their suite of products. If you found this video useful, please consider giving it a like, or click on the link above to check out my last stock analysis. Or continue to watch as we look at the possible return. The return we would receive, if we bought at our 25% margin of safety price, of $192, and sold in 10 years' time at our estimated future stock price of $1,037, would be 440%. But, this is dependent on our assumptions for the company being correct. In addition, Paylocity don't currently offer a dividend. If you have enjoyed this new video format, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, Paylocity scored 11.5 out of 12. For this, I will give them a tick. As for the past results, their average share price has been going sideways, and haven't seen sustained share growth since 2021. Therefore, I will give them a cross. Analysts are signaling Paylocity as a buy, but they are predicting they will grow between 12 and 89% over the next few years. Here they gain another tick. Using the EPS growth model I used earlier on, we created a buy price of about $192. Therefore, I will give the valuation a tick, as its current share price is below this. According to Morningstar, Paylocity have a narrow economic moat, due to their ability to offer an all-in-one solution to payroll and human capital management services, which has a high switching cost associated with it. So, I will give them a tick. My final overall rating is 4 out of 5 stars. To be honest, the 12 key pillars are the essential part of my process. A company must score over at least 7 of them, for me to seriously consider the stock. Therefore, I have given this a category A rating within my own stock watch list. Lastly, these other checklist items are important, and are worth considering before purchasing a stock. The first one is to see if there has been any insider buying or selling of shares. This will give us some behind-the-scenes insight on if they are cashing in on stocks before an earnings call, or grabbing more stocks before it takes off. Secondly, make sure you keep up to date with the news for any company you are following, so you can better understand why a stock is trading higher or lower. And lastly, conduct your own research. It is important to create your own rationale and thesis for why you are buying into a company, based on your own findings and personal conviction. The book, The Most Important Thing Illuminated, written by Howard Marks, is an excellent read, and illustrates the need for rational thought and independent thinking. Click on the link above to listen to the book summary. Thank you for joining me during this stock analysis video.